Did you know that 90% of day traders lose money in their first year? It's a shocking statistic, but here's what's even more interesting. While most traders are frantically trying to catch every market move, the world's most successful investors, like Warren Buffett, hold their positions for years, sometimes decades. You're probably thinking this doesn't make sense. If markets move every second, shouldn't faster trading mean more opportunities, more chances to profit? That's exactly what I thought when I started trading 15 years ago. But I was dead wrong, and that mistake cost me $50,000 in my first 6 months. Here's what nobody tells you about trading. The faster you trade, the faster you lose. Speed isn't your friend, it's your enemy. While everyone else is trying to be the fastest trader in the room, they're actually racing to the bottom. Think about it. Every trade you make comes with costs, emotions, and opportunities for mistakes. The more you trade, the more you multiply these problems. But patience compounds your advantages. By the end of this video, you'll understand why patience isn't just some virtue your grandmother preached about. It's your only sustainable edge in the markets. And I'm going to show you exactly how the world's top traders use patience as their secret weapon. But first, let me tell you about the biggest mistake I see traders make when they're trying to find their edge in the market. It's a lesson that cost me dearly, and it might be costing you right now. Look at today's trading landscape. You've got algorithms executing trades in microseconds, hedge funds with billion-dollar research budgets, and artificial intelligence analyzing more data in a minute than you could process in a lifetime. The speed and sophistication of modern markets is absolutely staggering. Remember when having a Bloomberg terminal gave you an edge? Or when being the first to read an earnings report mattered? Those days are gone. The moment you think you found an information advantage, there are already thousands of algorithms that spotted it milliseconds ago. But here's what's fascinating. While all this technology has eliminated most traditional edges, it's actually created a new one. You see, machines can't be patient. They're programmed to act on tiny inefficiencies immediately. They have to. Their edge is in speed. But you have the ability to do something they can't. Wait. Let me share something that blew my mind when I first learned it. Renaissance Technologies, arguably the most successful hedge fund in history, has an average holding period of just 48 hours. Yet Warren Buffett, the most successful investor of all time, holds his positions for an average of 20 years. How can both approaches work? Because Buffett isn't competing with Renaissance. He's playing an entirely different game. The psychological cost of constant action in the markets is enormous. Every trade triggers a cascade of stress hormones. Every position requires attention and emotional energy. And here's what nobody tells you. The more frequently you trade, the more you're exposing yourself to randomness rather than edge. Later, I'll tell you about a trader I know who turned $50,000 into $5 million over 8 years. Want to know the crazy part? He only made 12 trades total. While everyone else was burning out trying to catch every move, he was doing something that seemed impossibly simple, but I'm getting ahead of myself. First, we need to understand why traditional trading edges are dying, and why that's actually good news for patient traders like you're about to become. Think about the last time you watched the markets move. Every tick, every swing, calling out to you for action. The screens flashing red and green, prices dancing, opportunities seemingly everywhere. It's maddening, isn't it? That urge to do something, anything, is almost overwhelming. But here's what's fascinating. This overwhelming urge to act is exactly why patience has become such a powerful edge. In a world where algorithms execute thousands of trades per second, your ability to sit still and do nothing is your secret weapon. Let me show you what I mean. Back in 2019, I worked with a trader named Mike, who was consistently losing money, despite having a genuinely good strategy. When we analyzed his trading journal, we discovered something striking. His initial analysis was right 68% of the time, but his actual trading results were negative. Why? Because he couldn't resist improving his positions. He'd take profits too early, add to losing trades, or jump into new setups before his planned entries triggered. This is what I call the action bias, our deep-seated belief that more activity equals better results. It's the same reason soccer goalkeepers dive for shots, even when standing still would give them a better chance of making the save. We're hardwired to act, to do something, anything, rather than nothing. But here's the counterintuitive truth. In trading, activity is often the enemy of profitability. Every trade you take has to overcome spreads, commissions, and slippage. More importantly, Every trade is an opportunity to make an emotional mistake. It's like being a boxer. You don't get hit when you're not throwing punches. The math backs this up. Studies of retail trading accounts consistently show that the more frequently someone trades, the more likely they are to lose money. One particularly striking study from Taiwan showed that the traders who traded the most underperformed those who traded the least by a staggering 6.5% per month. Think about that. The most active traders were essentially paying a 6.5% monthly penalty for their inability to sit still. That's like starting every month in a 6.5% hole just because of overtrading. But I get it. Sitting still is hard, really hard. When you see the market moving without you, when you feel like you're missing out, when your ego is screaming at you to prove yourself, those are the moments that separate the consistently profitable traders from everyone else. Remember that trader I mentioned earlier, the one who made $5 million with just 12 trades? His name is David, and in a moment, I'm going to break down exactly how he developed the patience to wait months for the perfect setup. His story completely changed how I think about trading, and it might just be the most important lesson you'll ever learn about market psychology. But first, we need to understand why our brains make patience so difficult and how top traders have learned to rewire their psychological responses to market movement. Because once you grasp this, everything about trading becomes clearer and a lot more profitable. Think about the last time you sat in traffic. That overwhelming urge to change lanes, even when you know it probably won't help. Your brain screams at you to do something, anything, rather than just sit there watching other cars inch forward. That same instinct that makes you weave through traffic is exactly what destroys most traders' accounts. We're wired for action. Our ancestors didn't survive by sitting still when they were hungry. They hunted, gathered, and adapted. But in trading, this action bias becomes our worst enemy. Every time you check your phone for price updates, every time you flip through time frames looking for setups, you're feeding a dopamine loop that makes patience even harder. Here's what's happening in your brain. Each time you place a trade, you get a little hit of dopamine, the same neurotransmitter that makes gambling so addictive. Win or lose doesn't matter as much as you'd think. It's the action itself that hooks you. That's why even losing traders keep coming back for more. Remember the famous Stanford marshmallow experiment? Kids were given a choice. Eat one marshmallow now, or wait 15 minutes and get 2 marshmallows. The kids who could wait went on to have better life outcomes across the board. Better SAT scores, lower BMI, higher income. Trading is your marshmallow test, played out every single day in your brokerage account. I learned this lesson the hard way by watching a friend, Mike, blow up a $100,000 account in just 3 months. Mike was brilliant. PhD in mathematics, worked at a hedge fund, knew more about options pricing than anyone I'd ever met. But he couldn't sit still. He needed to be in every move, every day. The market's up, I need to be long. The market's down, I need to be short. At first, it worked. He was up 40% in his first month. But then the inconsistency of his rapid-fire trading caught up with him. Big winners were followed by strings of small losses. Those small losses started getting bigger as he tried to make back what he'd lost. Within 90 days, he was down to his last $7,000. You might be thinking, that won't happen to me. I have better risk management. But here's what nobody tells you. Risk management isn't just about position sizing and stop losses. It's about managing your own psychology. Every trade you take is a withdrawal from your patient's bank account. And just like a real bank account, when you overdraw, the penalties are severe. The average retail trader makes 3 to 5 trades per day. That's around 1,000 trades per year. Professional traders I know, the ones who actually make consistent money, might make 100 trades in a year. Some make even fewer. They're not trying to catch every move. They're waiting for the perfect pitch, just like a professional baseball player who knows better than to swing at everything that comes near the plate. This is why most trading educators are selling you a fantasy. They show you setups that work in hindsight, indicators that would have caught the perfect move, but they never address the hardest part, the psychological stamina it takes to wait for those setups in real time. But what if I told you that patience isn't just a personality trait, it's a skill you can develop systematically, that there are specific exercises and techniques used by elite traders to strengthen their patience muscle. In fact, the same method that helped David make those 12 perfect trades I mentioned earlier can work for you too. Let me show you exactly how it works. Let me share something counterintuitive. Patience isn't about doing nothing. It's about doing the right nothing. Think of it like a sniper who spends hours perfectly still, waiting for exactly the right moment. They're not passive, they're intensely active in their stillness. That's the kind of patience that makes money in the markets. I learned this lesson the hard way, back in 2008. I was taking 5 to 6 trades a day, convinced that more activity meant more profit. My account was like a leaky bucket, small losses adding up faster than my occasional wins could fill it. Then I met James, a former hedge fund manager who traded just 3 to 4 times a month. He showed me his trading journal. In 6 months, he'd made more than I had in 2 years, with just 19 trades. Here's what separates strategic patience from regular patience. It's systematic. You're not just sitting there hoping for something to happen. You're actively filtering opportunities through a rigorous framework. Warren Buffett explains this brilliantly with his 20 punch card rule. Imagine you only get 20 trades in your entire life. How differently would you approach each decision? You can build this kind of patience systematically. Start by cutting your normal trading frequency in half. If you typically make 20 trades a month, cap it at 10, then have it again next month. You'll feel uncomfortable at first. That's good. Growth happens at the edge of discomfort. But here's the key. While you're waiting, you're not doing nothing. You're analyzing, journaling, reviewing. Every setup you don't take becomes a learning opportunity. Ask yourself, if I only had 5 trades left this year, would this be one of them? This simple question will transform your decision-making process. Position sizing plays a crucial role here. When you trade less frequently, you can afford to size your positions larger, but only if each trade meets your stringent criteria. This is how patience compounds your edge. Instead of spreading your capital thin across dozens of mediocre setups, you concentrated on your highest conviction trades. Think about the last 10 trades you took. How many of them were truly A-plus setups? If you're like most traders, maybe 2 or 3. Now imagine only taking those A-plus trades and sizing them properly. That's how the professionals do it. They don't try to be heroes. They wait for the market to serve them softballs. You might be thinking, but what if I miss opportunities? Here's the truth. The market will always be there. There will always be another trade. The real opportunity cost isn't in missed trades. It's in the capital you lose taking subpar setups. Every dollar you lose has to be made back just to break even. I want you to try something. Start keeping a trades I didn't take journal. Write down every setup that tempted you but you passed on. Track what happens to those setups. You'll be amazed how many would have been losses. This exercise alone will strengthen your patience muscle more than any indicator or system. Remember that sniper we talked about? They don't celebrate how many shots they took. They celebrate their hit rate. Your goal isn't to be the most active trader. It's to be the most precise. And precision requires patience. But patience alone isn't enough. You need to understand the mathematics behind why waiting is so powerful. In fact, there's a fascinating principle called the Kelly criterion that explains exactly why fewer, better trades will always outperform a high-frequency approach. Let me show you how this works. Let me show you the mathematics that make patience so powerful. The Kelly criterion, developed by John Kelly at Bell Labs in 1956, isn't just some abstract formula. It's the key to understanding why waiting for perfect setups is your greatest edge. Here's what nobody tells you. The math shows that even a small increase in your win rate dramatically improves your long-term returns. Let's say you're currently winning 50% of your trades with a 1-to-1 risk-reward ratio. If you could boost that to 60% just by being more selective, your expected return per trade nearly triples. This isn't theory, it's mathematical fact. But it gets even better. When you combine higher win rates with proper position sizing, the results are staggering. Paul Tudor Jones demonstrated this perfectly during the 1987 crash. While others were gambling their whole accounts, he kept his positions small and waited for the perfect moment. When Black Monday hit, he tripled his money because he had the patience to wait and the capital to act decisively. Think about compound growth for a moment. If you lose 50% of your capital, you need a 100% gain just to break even. This asymmetry means that survival isn't just important, it's everything. Every time you overtrade, you're not just risking money on that specific trade, you're risking your entire future compound growth potential. I've worked with hundreds of traders, and I can tell you that the ones who make it aren't necessarily the smartest or most talented. They're the ones who understand that trading is a game of survival. They know that their edge isn't in some magical indicator or system, it's in their ability to wait for perfect setups. Here's a simple exercise that will transform your trading. For the next month, Cut your typical position size in half and only take trades that meet every single one of your criteria. No exceptions. What you'll discover is that your stress levels drop dramatically, your win rate improves, and paradoxically, your total profits will likely increase. The mathematics of compounding work silently in the background, but they're relentless. A trader who preserves capital and waits for A-plus setups might only trade a few times a month, but over a year, they'll outperform the hyperactive trader who's constantly in and out of the market. Think of it like this. Every trade you take is like planting a seed. You can plant 100 seeds in poor soil with inadequate spacing, or you can plant 10 seeds in perfect conditions with room to grow. The patient gardener always produces a better harvest. But here's where it gets really interesting. There's a psychological phenomenon that occurs when you trade less frequently, something I call the clarity effect. When you're not constantly in positions, your mind clears and you start seeing opportunities that were invisible before. Your pattern recognition improves because you're not clouded by emotional baggage from recent trades. The real edge in trading isn't about having better information than everyone else, it's about having better judgment, and better judgment comes from the clarity that only patience can provide. In fact, what I'm about to share with you next will show you exactly how the world's top traders use this principle to create extraordinary returns. Let me tell you about James, a trader I mentored who turned $50,000 into just over $5 million in 7 years. But here's what's fascinating. He only traded an average of 6 times per month. When other traders heard this, they couldn't believe it. That's impossible, they'd say. You need to be in the market more than that. But James understood something crucial. Patience isn't just a virtue in trading. It's your only real edge. Think about it. Every other advantage you think you have, your technical analysis, your fundamental research, your sophisticated algorithms, thousands of other traders have access to the same tools. Many of them are better educated, better funded, and better connected than you'll ever be. Your true edge comes from being able to do what they can't. Wait. Wait when others are jumping in. Wait when the FOMO is crushing. Wait when it feels like you're missing out on the trade of the century. This is the moment everything changes. When you truly internalize that patience isn't just about avoiding bad trades, it's about accumulating potential energy. Like a leopard in perfect stillness before the strike, your power comes from your ability to remain motionless until the perfect moment. I've seen traders transform their entire careers once they grasp this truth. Everything we've discussed, the position sizing, the risk management, the psychological control, it all becomes possible when you master patience. It's the master key that unlocks every other door. Look at any consistently successful trader's equity curve. You'll notice something striking. The periods of their biggest gains often come after long stretches of minimal activity. They're not just waiting, they're building pressure, like a dam holding back water. When they finally act, all that accumulated patience converts into precise, powerful execution. This is why the greatest traders in history, from Jesse Livermore to Paul Tudor Jones, all emphasize the importance of waiting. They understand that trading is not a game of constant action, but of extreme selectivity punctuated by moments of decisive action. And now that you understand this fundamental truth, let me show you exactly how to implement this in your own trading, starting with 3 specific techniques that will revolutionize your approach to market timing. So how do you develop this edge of patience? Start with these 3 daily practices. First, before every trading session, write down your exact entry criteria, not just price levels, but the complete setup. This forces you to define what perfect looks like, making it easier to wait for it. Second, keep a trades I didn't take journal. Write down every impulse trade you successfully avoided and calculate how much you saved by staying patient. You'll be shocked at how quickly these avoided losses compound into real edge. Third, set a daily maximum trade limit. When you know you only get 3 trades per day, you'll naturally become more selective. It's like having a limited number of bullets. You'll aim more carefully. Remember that statistic we opened with? The top 1% of traders execute 70% fewer trades than the average trader. That's not coincidence. It's causation. Their patience isn't just a virtue, it's their weapon. The market will always be here tomorrow. The opportunities never stop coming. Your only job is to wait for the perfect ones, the ones that match your criteria exactly. Because in the end, the market doesn't reward intelligence, speed, or even skill. It rewards survival. And survival belongs to the patient. Start your patience journey today.